I'm sure the world's listening. Anyway, welcome. And we've got 4 things to discuss today. We're looking at Cyprus tax, capital gains for expats, flat rate tax for expats, and lifting lockdown. So for expats in Cyprus or based in Cyprus for their tax residents, it's a great location for expats. And with COVID and changes to their tax system regarding health, then the tax returns for 2019 can only now be submitted. Generally, they have to be submitted within 3 months. They haven't confirmed exactly when that will be now. They should normally be in by the end of June. We can only submit them from the 1st of June. Now, for expats, there's a new tax, a Cyprus health tax. It's payable, and it's payable on worldwide income. So if it's not deducted at source in Cyprus, then overseas property rental income, pension income, work abroad, even if it's not remitted into Cyprus, is still taxable for this health tax. So there's quite a lot of changes coming into effect that expats need to consider. You could have an exemption certificate for non-dom status. That doesn't affect this issue of the health tax. The only way that you don't pay the health tax is if you have got an S1 EU exemption form as an EU expat living and working in Cyprus. It's the only time that you don't pay the health tax. So contact us at ProACTpartnership.com if you want to discuss what your liability is and how it might work for you. Second topic to look at today, slightly differently, is capital gains tax for expats. Now, when an expat buys a property in Cyprus and sells it, there's no allowances generally other than inflation linking and the costs of buying and selling and improving the property against capital gains tax. So everybody, whether it's your main home or business or any other property, is subject to a flat rate capital gains tax of 20% on sale when that property is disposed. Now that assumes the property goes up in value, which it may or may not do, but it's inflation linked and you allow the cost of sales. That's fairly standard for capital gains tax around the world. But the point is that that's a capital gains that arises in that country. So if you're a British expat with property in the UK that is sold, you're still going to have a liability to capital gains tax. And the laws changed in April 20 this year, so that capital gains tax assessment has to be going effectively as soon as the sale is done with the conveyance. It says within 30 days, but in practice that means that the capital gains tax assessment has to go in at the time of the sale of that property. But if you had shareholdings in the UK or business holdings in the UK, those two could be subject to capital gains tax. So any capital gains tax item in a country is subject to tax in that country. So it's nothing to do with your tax resident, it's where the tax allows. So under a double taxation treaty, an expat pays tax once in one country. So if the expat is resident in, for example, Portugal, he may now have no Portuguese liability to capital gains tax on that overseas property. However, the property sold in the UK will still be subject to UK capital gains tax. But if that capital gains tax on a residential property in the UK is 28% and the equivalent tax is 20% in Cyprus, you won't pay any more tax in Cyprus. So expats, while they can mitigate and have all their income, investment income and pension income and earned income taxed in their overseas location, when you've got fixed income of some sort which is generating a capital gain, including inheritance tax is a form of capital gain, that's still charged in the home country. The other big factor to consider here for UK expats with public service pensions is that under the new double taxation treaties that are being introduced from 2017, the public service pension can also be taxed in the home country. So if you've got a Bulgarian state pension, so public service pension, and you're living in the UK, that public service pension could, under the new rules, be taxed in Bulgaria, even though you're living in the UK. So UK expats have that potential liability as well. So you're not necessarily going to avoid a capital gains tax on property, business, or public service pensions as a UK expat living and working abroad. So the things to review and consider: there are ways of holding those assets to avoid a capital gains tax liability, and for that you need to talk to the ProACT tax saving experts, specialists for expats, and UK expats around the world. Contact us at proactpartnership.com. Got quite a good guide about automatic exchange of information between tax officers, which we'll see really kick on with the COVID, with the government's getting even more location and personal data on individuals and expats around the world. So go along and download a copy of our automatic exchange guide from our website. So the third topic today takes us on to lifting lockdown. How can we move on from where we are? So expats, UK expats locked in the UK or any other jurisdiction where they were told that they couldn't fly, or they needed a reasonable excuse to leave home and they had to work from home, or as in the case of the UK government, all UK nationals advised not to travel and return to the UK. Those conditions, the Coronavirus Act of 2020 has meant that UK expats locked down in the UK can use a 60-day period as a reasonable reasonable excuse for exceptional circumstances to claim an extra 60 days resident in the UK. Now that lockdown period has extended from the 6th of April this new tax year. So if you're already locked down in the UK, you can actually use that excuse in your 2019-20 return as well as in 2021. But the 60 days will be up by the beginning of June. And with on the 1st of June, the lockdown being eased again, then you need to carefully reconsider what your position is in terms of impacting on your non-resident status for 2021. Now you may still be allowed 90 days, but it depends then about your working situation, your ties that could impact on that. So the 60 days for exceptional period finishes at the beginning of June. You need to look at different ways and make sure that you don't breach that before you're able to relocate back to your country of residence without compromising your non-resident UK tax status for the current tax year 2020-21. If you want a free review with that, you can contact us at our website and we'll set up a review with one of our consultants to look at your ties and your guidance about how your tax residency could be affected as we're lifting lockdown. Many businesses will change and change forever, working with online, and if your overseas business needs advice and guidance on how to organise itself to work online, again, we've got those facilities from our experience and from our expertise that we already had to create an online platform for you to work with your team and get that guidance going through. So again, contact us at proactpartnership.com. Final topic for today is flat rate tax for expats. Flat rate tax sounds good, but the devil is in the detail, as always. Okay, so many countries have progressive tax rates. So in Thailand, you could pay no tax on your first £3,500 of income, but the progressive income tax rate goes up to 35%. You may have a nil rate tax regime in a Middle East country like Dubai, or you could have a progressive tax rate where tax rates might start a relatively high 20%, but with bigger personal allowance, like in Cyprus. So different regimes offer different options, but there are countries that offer expats working abroad a flat tax regime, but also like Montenegro, for example, although they have introduced a tier recently, so it used to be a flat rate 9%, and now there's a 9% and an 11% tax rate for people that are tax resident in Montenegro. So those regimes operate with progressive tax rates. In the UK, the tax rates go from 20 to 40 to 45%, and with an added twist that you can lose your personal allowance. If you lose the personal allowance of 12,500 when your tax rate is 40%, then actually that means you're going to pay an extra £6,000 of tax by losing that personal allowance, because it's taxed at 40%. So all these things are worth looking at the detail about how much tax you're going to pay and how best to organise your affairs. And so with countries like Cyprus, you've got a pension tax rate, which is a flat rate tax of 5% for people with pensions. It's a progressive tax rate for people earning, although there's a quite high personal allowance of £17,000. So people on low earnings or low pension incomes or high investment incomes could pay very little levels of tax in Cyprus. But there are flat rate levels that come in. We mentioned earlier the health tax, which is between 1.7 to 65% taxed on all income as a flat rate tax. But in Portugal, all expats could pay just a flat rate tax on their income in Portugal at 20% and their external income at 10%. Bulgaria has a 10% flat rate tax as well. Malta has a 15% tax. So they all sound very good, but which is better than the other? Republic of Ireland has a very low corporation tax rate alongside Cyprus at 12.5%, but it doesn't mean you pay less tax there. It depends upon what the rules and the conditions are, and each individual case is worthy of examination. So you could set up a Middle East company where there's no tax on the company, but it doesn't mean that you're not going to pay tax or have a liability elsewhere. What is the structure that suits your business best? But for retired expats or for expats living and working abroad or working overseas, there's some very interesting rules in the detail of a UK-based tax system where there are rules on remitted income. So in countries like Cyprus, you can become a tax resident, but if you're working abroad in Africa, in the Far East, but you're a tax resident in Cyprus for at least 60 days a year, you're only going to pay tax on your remitted income. So if your remitted income is quite low, then you could end up paying not very much tax. You could earn 100,000 abroad and not pay any tax. But Cyprus also, for expats, have a zero rate tax on dividends. So if you're working through a service company outside Cyprus, you could have 100,000 of dividends and 50,000 of earnings while working abroad and not pay any tax at all. So with the right location, the right organisation of your affairs, you can pay a very good level of tax. for more information on flat rate tax regimes and for a comparison of which is the best tax regime for you, call the ProACT expat experts and we'll see what we can come up with. It's always family first. You have to look at the lifestyle you want, where your family are and what you want to achieve. But around that, how much tax you're going to pay and how you're going to organise your business and property and capital assets to minimise the tax and so you can enjoy living and working abroad. So there's 4 topics there, lots of questions, lots of information. We'd like to hear from you. Give us your questions. We'll get back to you, we'll answer you in a private message, but also we might feature your questions next time. So we'd love to hear from you. Don't leave it too long and we'll speak to you next time. Thank you very much for listening.